Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Monetary Policy Committee will announce its first decision after the union budget today. 36 economists polled by Bloomberg expect the panel to maintain a status quo. The Union Cabinet approves amendments to the Banking Regulation Act to give the Reserve Bank of India greater control over cooperative banks, CEO appointments, audits and even the power to take control if financial health deteriorates. Avenue Supermarts is looking to raise nearly 4,000 crore rupees through a qualified institutional placement that opens today. Will issue up to 2 crore shares at a floor price of 1,999 rupees apiece. The death toll from the coronavirus outbreak has risen to 565 people, with the total confirmed cases crossing a number of 28,000. And while the markets are shrugging off those fears, one must feel for what's happening in China. I was reading articles about how mass meals in Beijing have been stopped. I think a lot of Chinese passengers or passengers moving out of China are not getting entry into select countries as well, was an article that I read. So it's a big issue. Just that the equity markets seem to be shrugging off the fears from an economic perspective. Frankly, if you look at the Dow, the Nasdaq or the S&P, that's what they did yesterday. They just completely shrugged off any kind of issues that might come in as a result of this. So the record highs continue for the US markets, and the S&P 500 in yesterday's session nudged to the fresh record high. So 37 odd points higher. But after a bit of a dip that we've seen in the S&P in a couple of sessions, it's bounced back very, very smartly and now trading at fresh highs. Asia too shrugging off the coronavirus fears completely. I mean, if you just look at the Nikkei, is up about 2%. So going strong. Hang Seng is up about 1.3%. Shanghai is about 1/3%. So if we thought that economics and supply chains and businesses are getting impacted, either liquidity or just callousness is really not taking that into serious account. The SGX Nifty, for its part, likely to start off on a quiet session today, quiet footing today. But remember, yesterday we had a start which was very, very quiet. There was hardly any movement on open yesterday, just that we closed very attractively. So you never know if that could happen, and the RBI policy could well be a determinant of that, though status quo is expected. Keep in mind, though, that I do think that the policy tone today and what they say in the policy today could well set the tone for the interest rate movement in FY21 or the expectations thereof. So very important policy. The first one, the RBI governor will react, if not in policy statement, then in questions to the moves taken by the government in the budget as well. So it's a very, very important policy that we have up our hand. Let's wait and watch what happens there. Traders, for their part, are very, very, how do you say, I say circumspect about what could happen today, because remember, it's also the expiry day. And while yesterday we were talking about how the range was very wide, if you just look at the options expiry for the weekly options expiry, which is today's expiry, you will see that the range is very, very tight. And I don't blame anybody. I think after the move that we've seen and a brisk up move that we've seen, and the fact that there is policy today, maybe, just maybe, people don't want to take too many aggressive positions right now. If at all, they might happen post-policy. Small buy numbers, both from DIs and FIs, but which is not bad after 3 days of selling. Yesterday we had a buy number. Today is a buy number as well. Small, but nevertheless it's a buy number, and we should take it with both hands. But it's an important day, not just from a perspective of policy, but also in terms of numbers, and not just from a Nifty perspective. We're now coming to the fag end. We have about 32 odd names delivered till now. Today there are 3 very interesting names, including the two-wheeler majors, Eicher Motor and Hero, which will be important, as well as Sun Pharma, which is very important. People will watch out for. So interesting names, all of which have beaten down, and therefore what they do in the quarter could well bring about a spurt if they indeed, either in commentary or performance, do well. But more important than the Nifty this time around, to my mind, are the broader end of the spectrum numbers today. The gas space would be active. Gujarat Gas has delivered. IGL comes out with numbers. We'll also have Aurobindo and Lupin, as well as Metropolis and the consumption names in Bata, Trent and United Breweries. So it's a very interesting day of results delivery, some during market hours, some post market hours. Do watch out for all of these. And in terms of stocks that I would be monitoring in the session today, HPCL, though I don't know if the crude price fall and the sentiment around OMCs will let this stock come off, but the numbers left a bit to be desired. They were below estimates. GRMs were $1.79 to a barrel versus 2.83, and adjusted for the inventory gains, GRMs were even lower at nearly about $1.45 per barrel. So it's not a very healthy quarter. I don't quite know if the stock will react negatively as much. Even if it does, will it recover? Because we've seen OMCs really do very well. So let's wait and watch. For the two pharma names, which is Cadila and Ajanta, the results were better than estimates. So number of factors working for both. Seasonality working for Cadila, and I think brokerages including CLSA have spoken very well about these numbers. So let's wait and watch also because of the valuations. And Ajanta Pharma too, margins were impacted by higher their expenses, but India sales were doing well, exports did well. So this one could be an interesting stock to monitor. And Divi's, the quarter met estimates, but a couple of sales notes and otherwise spoke about how this was a soft quarter and the fact that there is a large capex underway, which might lead to consolidation for the stock price at the current level. So let's wait and watch if that happens, or does this stock react in any fashion whatsoever. Avenue Supermarts, won't dwell too much on it because I will talk about it a bit later on. The company is looking to raise about nearly 4,000 crores via the QIP. This was much anticipated, but the reason why it assumes prominence is because Avenue Supermarts is arguably one of the largest retailers by market cap in India, and it is trading at record highs. So very important. We'll talk about that a bit, but watch out for this stock as well today. And lastly, I just think we should keep an eye out on life insurers. After the falls that have happened, brokerages are coming out with notes. Bank of America Merrill Lynch has initiated coverage with the buy rating on all three life insurers with target prices higher, at least 10% higher than the current prices for all of these. In the case of ICICI Prudential, slightly more. So do watch out for the three life insurers. Well, let's tell you what's lined up on First Word today. The top editorial stories that want to bring to you and can't get bigger than the RBI policy. Pallavi tells us why the 6-member Monetary Policy Committee may choose to stay put on rates. And we also hear out what some of the country's most noted economists have to say about the rate trajectory. Advait then talks about companies that stand to benefit from the higher foreign investment cap in corporate bonds. I run you through Avenue Supermart's latest fundraising plan. And Agam does a small comparison between Tata Elxsi and KPIT Technologies, and he tells us why it is important to note. It's the first Monetary Policy Committee decision after the Union Budget. The 6-member panel will no doubt have deliberated on the government's move to use the escape clause in the FRBM Act and slowing growth. But what might weigh more on their decision is retail inflation moving above the 6% mark. Pallavi Nahata sums up why all economists polled by Bloomberg expect the MPC to maintain the status quo today.
India's Monetary Policy Committee is widely expected to keep interest rates unchanged on Thursday. The committee had cut interest rates by 135 basis points in 2019 and then took a pause in December. While that pause was termed temporary, all economists expect the committee to stay on hold this time as well. 36 economists polled by Bloomberg all expect the repo rate to remain unchanged at 5.15%. While the policy is coming right after the budget, it will be the inflation picture which will seal the case for a status quo. Inflation has risen to above the 6% upper limit set by the committee. While most of this is driven by the 12.16% rise in food, inflation pressures are visible beyond just the vegetables category. So the committee may choose to wait and watch before it cuts rates again. Remember, the committee does not need to act on the current inflation rate, but forecast a future inflation. As such, the outlook for inflation 12 months from now is all important. Growth will remain a discussion point as well. While growth remains weak, there have been no adverse information flowing in between December and the February policy reviews. If anything, certain data points such as the PMI have reflected some level of stability. At 56.3, PMI for January is the highest in nearly 7 years. Now, typically, the monetary policy review after the budget is focused on the fiscal scenario. This time, while the headline deficit does suggest consolidation, there are enough concerns about the government's ability to meet targets for tax and non-tax revenue items like disinvestments. We don't expect to hear too much on the fiscal situation since Governor Shaktikanta Das has so far been fairly restrained in his commentary on the fiscal situation. However, we do hope to hear from him on whether the government's decision to invoke the escape clause will push the RBI to buy bonds. We also expect to hear the RBI's view on large borrowings from the National Small Savings Fund. Finally, what the bond markets are waiting to hear is the RBI's rationale behind Operation Twist. Remember, between the December and the February policies, the RBI initiated a program to buy long-term bonds and sell short-term bonds. The idea was to flatten the yield curve, which partly worked, but how long will the RBI continue with this? How often are they willing to intervene in the markets using Operation Twist? Bond traders will be looking for clues on those questions. Do log on to BloombergQuint on Thursday for the full monetary policy coverage.
Yes, indeed, we'll be here with the entire policy coverage pre, during and post. But speaking of the policy, Jehangir Aziz is the odd one out amongst four economists. The head of emerging market economics at JP Morgan believes that the RBI has room to cut rates by as much as 50 basis points in 2020. Others like Prachi Mishra of Goldman Sachs, currency and bond expert Anand Narayan and Kaushik Das of Deutsche Bank say the MPC has little choice but to stay put on rates.
We now expect at the minimum another 50 basis points of rate cut in 2021, and I would argue that the risk is more cuts than less cuts. Here is a budget that was presented, 3 weeks after news of the biggest shock that we are encountering in 2020, which is the coronavirus. This is going to have, or already is having, a significant impact in the region's growth and in global growth, at least in the first quarter. Chinese cities that have been closed down for already a week, and 10 days actually, February 9th, the first 9 days of February, represent about 80% of China's IP, and there is probably cause to believe that some of that might, in some of the cities, that restriction might even be extended. So I think we should brace ourselves for a 1Q global growth number that is, could be very, very, very surprisingly low. I'm not saying that there isn't going to be a recovery in the second quarter or in the third quarter and that we will not go back to where we were, but the major risk facing the world right now is an actual disinflationary, and on top of that another slowdown in growth. This could well prompt the Fed, and we already have that 25 basis points rate cut, the Fed to cut even more, and global disinflation to become even more aggressive. So my point is that, if you look at the global environment, and even in India, you just take away headline inflation, food inflation, and you're down to core, and core is at its lowest we've seen in many, many years. So my sense is that I know that, a headline number of 7.5% of inflation doesn't look, the optics are not right to do a rate cut. But, once that headline inflation rolls over, which is likely to roll over, I think the space for cutting rates is significant.
So overall, I think I would think due to all these three factors, inflation inching up, maybe a little bit more comfort on growth, and the role of other policies to complement, I think it seems a status quo would be more likely. They might change the stance from being accommodative to neutral.
Really?
Because
that'll shock the market.
I'm not sure if it'll shock the markets, because generally I think rates have been going up, right? And rates have been going up in the swap markets because with inflation going up, and again some comfort on growth as well. So I think it just opens, it opens the possibility of, if just in case, if the uncertainty around inflation gets more magnified, it gives you a window where you can, operate the other way. I do think the bar for raising rates is very high at this point relative to another cut.
Governor Das is in a bind as well. Inflation is way too high for him to cut interest rates at this point in time. But he has made it very clear that he wants to support the market, support the government, support the fiscal spend to the extent possible. Last year, inflation was low. The external context was absolutely benign, and therefore India could effectively afford to print and spend, and that's what it's been doing for the last 2-3 years. Those degrees of freedom are coming down. Inflation is on the higher side at this point in time. External sector is still benign, but you never know. Too much of the sprint and spend extended for too long, and you are risking financial stability. I'd much rather we went into actual, structural reform to address the core issues than keep playing around with Excel spreadsheets and hoping to print and spend our way out of trouble.
No, fair point. Kaushik, one quick word on monetary policy. Would you also expect a continued pause? We are in the midst of a credit market which is not functioning properly. There's no question of allowing interest rates to move up. But as I told you, the fiscal side of the story is such that it will have a natural tendency to push interest rates higher. And small savings interest rates will not come down because the government wants money. So the best that you can hope is RBI maintains the accommodative stance. I hope RBI doesn't change that to neutral, because that would kind of indicate that RBI is giving one possibility that at some point of time RBI can consider hiking rates. That could be damaging for the market. So at this point of time, you maintain accommodative monetary stance till you get to a point where you can consider whether you can cut interest rates or not, given the global growth could again slow down because of the virus in China. So we need to wait for that. At this point of time, wait and watch. I think from an RBI point of view, they'll get a lot of comfort that government has shown a 3.5% number for next year and wanting to bring it down to 3.1 in the next 2 years. So RBI probably will take that as a source of comfort and maintain the monetary policy stance as accommodative.
Well, let's wait and watch. We'll get to know about that decision in a few hours from now. Let's move on. The budget proposes to increase FPI limits in corporate bonds to 15% of the outstanding amount. But will a higher cap result in an immediate tide of foreign money for India? Are bonds issued by India Inc. truly in demand amongst FPIs? That's the key question, isn't it? An analysis by BloombergQuint indicates that the easier norm is likely to benefit public sector companies and some AAA rated firms the most, but not in a hurry. Advait Rao Palepu is here to explain why. Advait, good morning.
Good morning, Neeraj. So essentially, FPIs have been selling off their debt investments over the last year. And actually, the year ended with net debt outflow from the FPIs. Essentially, because there have been several credit risk events that have taken place in the bond markets, whether it's defaults by NBFCs or even by other manufacturing firms or even media firms, as you know. So then there is a credit risk factor that's playing into this picture. So the FPIs would prefer safer bonds such as PSU bonds, which have a quasi-sovereign guarantee that the government will not let these entities, whether it's the National Highways Authority or NHPC, NTPC, these sort of entities, default on a bond. So they'd rather place their risk there, while at the same time, from a more global perspective, they are trying to search for higher yields. So in this higher yield environment, India is better off compared to the Western developed economies. But over the last year, they've moved their money to Indonesia and China. Now, this is also because of regulatory reasons. The RBI had introduced sectoral limits, concentration limits. So the FPIs tend to be underweight in India. So even at the current FPI limit of 9%, which has been increased to 15% in the union budget, even at 9%, they're underweight in corporate bonds by nearly 50%. So the limit is at around 3.13 lakh crores. They're invested only 1.87 lakh crores. So there are multiple factors that are playing in. Macroeconomic risk, which over the last year has slowed down in India. The fiscal deficit also has become an issue for foreign investors. Then you've got sectoral risks, such as the NBFC sector. So you could see some reduction in their holdings in NBFCs, especially when NBFC AAA papers are limited in supply. The NBFCs that were raising money from foreign investors 2 years ago may have not come back to the market at the same pace that they did before. So we could see some amount of PSUs and NBFCs or even some specific power utility companies raise funds from FPIs, because these seem to be better rates, less risk, and from a longer gestation point of view, there could be tax incentives for the foreign investors as well.
But this may not happen in a hurry.
It will not happen in a hurry, because the calls on each of these investments will be taken at significant points of time, and it will depend on the specific company's risk once the exchange rate risk, the macroeconomic risk, the country risk, and the sectoral risks are accounted for.
Okay. Well, interesting to note that, and yes, much debated topic on the budget day, and some analysis out here is always helpful. Advait, thanks so much for putting that for us.
Thank you.
All right, that's Advait Rao Palepu with that piece. So watch out for these limits benefiting a select few companies, and that too not necessarily with some immediacy, but over a staggered period of time. Well, what could find money coming in though is Avenue Supermarts. It's delivered a stellar rally over the past month, even ahead of the fundraising that begins today. And I'm just trying to put into perspective both the things. One, what is fueling the rally, and the fundraise and how it will help Avenue Supermarts, and then just a small bit on valuations. Now, look at what's happened. I mean, for Avenue Supermarts, the last few years, what they've done, and it's quite stunning, really, isn't it? There's been consistent growth that the company's shown. The EPS growth has been nearly 35% per annum over the last 3 years at least, if not more. And the store expansion that Avenue Supermarts is putting out is happening without any kind of major margin dilution. That's the key thing. If you just look at what Avenue Supermarts has done over the last few years, keep in mind from FY15 to FY19, D-Mart, which is Avenue Supermarts, doubled the number of stores without any kind of margin dilution, which is quite stunning really for a company of its size. So it's been able to do this without any major disruptions on margins. Now, one of the factors that is also leading to this is a very tight lid on costs, and I've borrowed a chart from a note that Ambit Capital put out in the month of December, wherein they are showing how the cost structure for Avenue Supermarts is vis-a-vis the others. So the two nearest names that I could think of, or that Ambit has thought of, Spencer's and Future Retail. Now look at employee costs, look at ad or promotion spends, nearly negligible or almost zero because they just do not advertise, as well as other operating expenses, wherein Avenue Supermarts has a big edge over its competitors. So it's able to open stores, and much as people would think, how is it that Avenue Supermarts is able to keep the margins intact? It's probably because some of these. And of course, what also works for the stock price is the promoter group, and the fact that the free float is just so little. That's what the QIP might aid actually, to increase the free float. But just look at it. Promoters own nearly 80%, institutions hold about 11%, and the 9% which is held by others is also people don't come out and sell despite the valuations. So therefore, there is very little to buy, and any kind of major buying that happens in Avenue Supermarts, the stock would just zoom up. Now, the latest announcement is the QIP announcements that they've announced that is open for subscription. We hear that there is strong demand, but without getting into that, keep in mind, the announcement is that they're going to raise about 3,998 crores via QIP that opens today. It'll be interesting to see the response and the nature of the investors. Rumor also has it that there is probably an OFS coming, but we don't have details of that. What we have details of is that the QIP is getting launched, or has gotten launched, and likely will see some strong demand. Now, it's about 2 crore shares, maybe a 5% discount to the floor price, and the full amount will result in an equity dilution of about 3% which helps the promoter stake to come off from the current 80% promoter and promoter group, from 80% to the threshold that is required of 75%. What would this be used for? Well, I looked at the presentation that the company gave out post its results. They have spoken about how organized retail, in that presentation, they've spoken about how the organized retail will grow at about 1.6 times of overall retail, and Avenue Supermarts is expanding footprint in Central and North India, and obviously they need funds for store expansion over the next 3 years. So no doubt that this is what it is being used for. So the question then happens is that everything is looking okay, our valuations looking okay. Well, clearly not. Avenue Supermarts, as we all know, has always been expensive. Just look at this. This is the Bloomberg chart that we have, and it's trading at 80 times FY21 EPS as per Bloomberg estimates. Current year would be maybe around 100, 104 or thereabouts, but FY21 about 80 times. So it's not cheap at all. But the Ambit note also had this very interesting point about valuations on Avenue Supermarts, wherein they mention, this is their belief of course, but they say that this is when they wrote the note on January 8th. They said that valuations of 68 times and 54 times of FY21 and FY22 EPS will fade quickly as earnings compound 23% over the next decade. They are factoring in a 23% earnings CAGR over the next decade. And if they need, Avenue Supermarts manages to clock that, then there shouldn't be a concern. But I must say that if you look at the consensus, Avenue Supermarts has outperformed quite materially, and it's trading well above the consensus target price, and therefore the return potential would be negative about 15%. The question is, will people believe in this sell-side analyst reports and go out and sell the stock, or will they believe in the management which has delivered steadfastly over the last few years and continue holding it? $1 million question. You can take your pick. From Avenue Supermarts, moving on to the last analytical piece. Tata Elxsi has outperformed KPIT Technologies over the past year, but is the higher valuation warranted, and how do the business prospects compare? Agam is standing by to tell us what analysts prefer and why. Agam, why did you think of doing this?
Well, I was actually looking at technology companies which cater to advanced driver solutions as well as driverless cars, and KPIT Technologies and Tata Elxsi are the two companies which cater to it. And contrary to what one may think, in terms of revenues, KPIT Technologies is actually bigger than Tata Elxsi. So they garner more, but its market capitalization is half of Tata Elxsi. So it came across as a very interesting point. I started digging in, and some very interesting variables coming through. So I'm going to start off with, of course, the comparison. So over the last 12 months, we've seen Tata Elxsi advance by around 9% against KPIT Technologies, which is down as much as 6%. Do remember that KPIT Technologies has been listed on the exchanges for only 1 year. This was when the demerger from Birlasoft happened last year. So in terms of revenue, okay, outlook as well, what are analysts factoring in? Well, from FY19 through FY22, a lot of these analysts are expecting 14% CAGR for KPIT Technologies, where its FY20 revenues are estimated to be around a little less than 2,200 crores. Tata Elxsi, which has the higher market capitalization, is only expected to grow as much as 8% on a CAGR basis in the same period. That's where its revenues stand at around 1,600 crores. So clearly a 1,000 crore difference between KPIT Tech as well as Tata Elxsi. Let's move on and talk about operating margins. Here, of course, Tata Elxsi has an upper hand, certainly. It's expecting about 21% operating margins, but we're also looking at a potential drop around well over 5% on year-on-year basis because of the fact that we had a relatively volatile time for Tata Elxsi. KPIT Tech, on the other hand, we're expecting EBITDA margins to expand by as much as 250 basis points to around 14.10%. Moving on in terms of return ratios, again, this is the reason why Tata Elxsi may be enjoying higher valuations is because its return on equity and return on capital employed stands at 23% each. For KPIT Tech, it's barely 15% for return on equity, and ROCE is at around 14%, which comes down to earnings estimates, and rather price to earnings estimates. So Tata Elxsi is currently trading at a significant premium of around 28% as against KPIT Tech. If you consider all these factors, sure, the Tata Elxsi has certain reasons as to why it may warrant a higher valuation, but it doesn't mean that Tata Elxsi, it doesn't mean that KPIT Technologies is not picking up. And that's the reason why analysts are more bullish on KPIT Technologies, where they see a return potential of 30% from current market levels, as against a decline expected for Tata Elxsi of as much as 10%. And well, that tells you a story of how things are stacked up. It was just interesting that because KPIT Technologies is not so well tracked, it would be, I was interested in as to what's going on with this company, and some very surprising results coming there.
And the management sounded very optimistic when they spoke to us as well, Agam,
yes.
KPITs.
Yeah.
Okay, interesting piece. Thanks so much for putting that into perspective. Well, I'm sure at some point of time, today or tomorrow, we'll have a nice little story around this very interesting analytical piece by Agam Vakil. That's all that we have on First Word today, though, but lots more lined up on Indian Open. We discuss expectations from the Monetary Policy Committee today with Manish Vadhavan of Serenity Macro Partners, and earnings with MK Surana of HPCL, Kamlesh Gandhi of Mass Financial Services, and Umang Vora of Cipla. But after this break, a full tilt towards the day's trade.